Welcome back to Ticker Shock, the podcast where we cut through the noise and analyze what truly moves a stock's value. I'm your host, Dave, and today we're diving into the turbulent skies of Delta Airlines, ticker symbol DAL. All right, let's get straight to the shock that's rattling Delta. The single most dominant market narrative driving DAL's price action right now is the U.S. Justice Department's aggressive push to revoke Delta's antitrust immunity with Aeromexico. Now, why is this a big deal? Well, it directly threatens the profitability and operational flexibility of their international routes, especially in Latin America. This kind of regulatory uncertainty, combined with those ever-present cost pressures in the airline industry and some mixed financial results, is heavily influencing how investors view Delta right now. So, the big question is, does this news justify the price drop we might be seeing? To understand that, let's get a clearer picture of Delta itself. Delta Airlines, headquartered in Atlanta, is a global powerhouse. They provide scheduled air transportation for passengers and cargo across a massive network, hitting over 300 destinations in more than 50 countries. Think hub and spoke models through major cities like Atlanta, Detroit, Paris, and Tokyo. They've got diverse revenue streams, from their various cabin classes like Delta One and Main Cabin, to cargo services, and of course, their very popular SkyMiles loyalty program, which gets a big boost from their American Express co-brand credit card. They even have their own maintenance division, Delta Tech Ops, which is pretty unique. Now, how does Delta make its money? Looking at their latest annual filings, the vast majority, about 92.47%, comes from their core airline segment, with the remaining 7.53% from their refinery operations. Geographically, it's heavily weighted towards the United States at 70.58% of revenue. But here's where the news gets interesting. Their Atlantic routes make up 17.09%, Latin America accounts for 7.4%, and the Pacific brings in 4.93%. So how does this antitrust news specifically impact Delta's earnings? As we just mentioned, the Latin America segment, which contributes about 7.4% of Delta's total revenue, is directly in the crosshairs. Losing antitrust immunity here isn't just a minor bump, it implies significant competitive disadvantages. We're talking reduced passenger volumes, lower yields on key routes. It's a real threat. Our analysis estimates a 15 to 25% decline in revenue specifically from that Latin America segment. Let's take the midpoint of that range, about 20%. That 20% decline in Latin America revenue translates to an approximately 1.48% reduction in Delta's total company revenue. Now here's the kicker. The airline industry has notoriously high fixed costs and significant operating leverage. So even a seemingly small 1.48% revenue reduction, especially one tied to a clear threat to international route profitability, will lead to a proportionally larger negative impact on net earnings. Based on these factors, we're projecting an overall negative impact on Delta's quarterly earnings of approximately 3.5%. Our confidence interval for this impact ranges from a -2% to a -5%. This wider range reflects the significant uncertainty around the precise financial implications of potentially losing that antitrust immunity. The exact financial contribution of their Aeromexico partnership isn't fully disclosed, so we have to make some informed assumptions. All right, let's talk valuation. We've used a couple of methods here, pulling data directly from finviz.com to see what this news might mean for Delta's share price. First, using our discounted cash flow, or DCF model, which relies on various assumptions about future cash flows, our initial base case valuation for DAL came in at around $130.31. However, factoring in the impact of this new information, our expected case fair value sits at about $125.75. In a more optimistic scenario, or best case given these new developments, we see a value of $127.71, which is roughly 2% lower than our initial DCF base case. On the flip side, a worst-case scenario, where the impact is more severe, brings us down to $123.80, which is approximately 5% lower than that initial base case. But we don't stop there. We also look at simpler metrics. Using a PEG-based valuation, which compares a stock's price-to-earnings ratio to its earnings growth rate, we get a fair value of about $88.67. So, when we tie it all together, the expected fair value given this news hovers around $125.75. In a more challenging scenario, we could see a downside towards $123.80. But if things play out on the more favorable side of this news, we might see it closer to $127.71. It's clear this regulatory hurdle is significant, and the market is digesting the potential hit to Delta's international profitability. All right, so to wrap up our look at Delta Airlines, please remember, this is ticker shock, not financial advice. Do your own thorough research, consult with a financial professional, and understand your own risk tolerance before making any investment decisions. Thanks for tuning in. I'm Dave, and I'll catch you next time on Ticker Shock.